Welcome back to the Trade Room, everyone. Today's Tuesday, June 4th, 2018. And want to go over disclaimers. It's something we have to do. I know I sound like a broken record, but the companies we are talking about in today's webinar is to be taken as educational and illustrative purposes only. I'm not your financial advisor, and the whole purpose of doing these trade rooms is so you take the information that we teach you and apply it so that you can do the research and analysis yourself and figure out whether this investment makes sense for you or not. If you want to copy me, that's fine, but I want you to learn how to do this on your own. So the company we do talk about today is to be taken as educational and illustrative purposes only and not to be construed as investment, advice, or recommendation. If you haven't completed the course yet, some of this information is going to be new to you. If you don't fully understand what we're talking about, and you probably aren't going to understand everything that we are talking about, everything's going to be explained in great detail in the course. So go back, take the course material. Also, we do have a live Q&A every Wednesday at 12 o'clock Eastern Time. If you have any questions, make sure you ask them then. If you're unable to attend at 12 o'clock on Wednesday, we do provide recordings of all the content we put together for you. So you will have access to that. We're going to upload to the members section of the site. And then thirdly, if you're unable to attend the live events, you can always ask the questions on the members forum. So that forum is constantly being monitored by the trainers. Also, students like yourself have access to ask and give answers 24/7. Where is the market trend today? This is the S&P 500. And what we see here, we have just your traditional support line. So back here, right around the end of, here we go. So right here, February, it hit support, it bounced off of it, it came back down in April, right at that exact line, about 2,600 is where the price was. It bounced off of it again, almost hit it down here in May, and then bounced up again. But we don't have the traditional resistance line up here. Right around January 29th, the S&P 500 hit 2850. Then it came down a little bit, and you have these two peaks right here where the S&P hit 2800, a little less than 2800, and then down here it hit 2750. So you have three highs, all of which were lower than the previous. And what you see here, this is called a descending triangle. So lower highs with your traditional support line. And you have a green arrow right here on the moving average. Stochastics is red, got the red arrow right here. You have the green arrow right here with the MACD, and this is a reddish signal. So it came down here, it was green, then it came almost up to the overbought line, and then it came back down. That's called a fake arrow, but we still consider that a red arrow. So you have two greens and two reds. So the market's kind of been in this range all year. Today we're going to be talking about Cognizant Technology Solutions. Ticker symbol for Cognizant is CTSH, and they provide full lifecycle solutions to complex software development and maintenance problems that companies face as they transition to e-commerce. And the CEO is Francisco D'Souza. And this is the first thing I think about every time I hear the name Francisco. One of the million awesome lines from the greatest Christmas movie ever, Buddy the Elf. So year-to-date performance, Cognizant Technologies is up 8.6, so it's doing pretty good, especially compared to the S&P, which is only up 2.79, and it is lagging the technology index, which is the NASDAQ, and they are up 10.57% year-to-date. Here is a value line analysis report, and what we see here, digital-related sales advanced by nearly 30% in 2017. Cognizant should continue to have success in regard this year. Cognizant's using a combination of internal development and tuck-in acquisitions to expand its digital offerings and their share of overall revenues, thus helping to support a continuation of the rate of revenue growth to which investors have been accustomed. So over the long term, this company has been on a tear. It's been a great company growing the right way each and every year. And over here to the right, we see Cognizant's operating margin may only average 21 this year, but this is a meaningful improvement over the 19.7 recorded in 2017. We have worked the wider margins into our estimates and projections, and our targets have been adjusted upward. The combination of wider margins and continued top-line growth suggests that earnings may reach $6.60 a share in the next 3 to 5 years. And down here, we have the financials. The company has the highest financial strength rating according to Value Line at A++. Stock price stability at 70. Stock persistence, stock growth persistence, 85, and then earnings predictability is 100 out of 100. So solid numbers here. It's a great company. Then we go over to Seeking Alpha, and this is exactly why we don't trade any of the option transactions during earnings. So Cognizant Technology is down 4.9% on the first quarter revenue beat. Quarter one results beat revenue estimates and they met their earnings per share estimates, but they lowered their earnings per share guidance for the year by $1.09. So yeah, two things that look pretty good, and then the company fell 4.9%. So this is why we're not going to trade during earnings. And to come over to Morningstar, Cognizant reported a solid start to the fiscal year with revenue at the high end of management's targeted range. The firm provided a slightly updated full-year outlook, raising the low end of its revenue guidance by $50 million to $16.05 billion. And that's due to mergers and acquisitions, the lowering its full-year EPS by 6 cents to at least $4.47 based on an updated tax stance. And they see sustainable high single-digit top-line growth for the overall business over the long term. And then with shares trading close to their fair value, which is $80 a share, they're seeking a slightly wider margin of safety before considering it for investment. And after putting this presentation together here, went through all the analysis, and everything looks good, but the only downside to Cognizant so far is that it's not quite at a discount. And we'll show you that as we go along here. I just want to show you one more thing on CNBC. Now expected to pay higher taxes than previously thought, driving its shares down 6%. So when you take a look at their stock chart, everything's been chugging along quite nicely, and then right after the earnings report came out, it had a big dive. The forecast overshadowed double-digit growth in Cognizant's first quarter revenue that beat Wall Street expectations, and also predicted a 9-cent hit to the 2018 earnings per share due to an updated interpretation of the new U.S. tax laws. So I want to show you where we found all this information at. Come over here, and this is where I got the Morningstar information. So you go to Morningstar, type in the ticker symbol, and you go to stock analysis, and that gives you all this information here. I got the Value Line report. You go to Value Line, and what we do is we type in the ticker symbol right here, and go to PDF reports. That brings us here, and this is the page I use for a whole bunch of my investment research. And then midway, or a little bit more than midway down, this is where you see the analyst reports right here. Seeking Alpha, what I wanted to do is see if any of these headlines caught my eye. And over to the left, you have the analysis information. And the most recent analysis report was January 23rd. And then you had a couple in August and then last summer. So I'm not going to pay attention to any of this since it's so dated. But what we did, we came over here to the news. Cognizant goes ex-dividend on Monday, and that was an article on May 18th. What that means is you have to own the stock by Monday, the 21st, in order to get their dividend. Then you had two companies here that sold their shares, and they probably sold it simply because it had a nice run-up and it's overvalued. Just my assumption. Then you had the quarterly reports come out. Here's a transcript. Here's a transcript of that call, and this is the article that I just showed you where the stock fell 4.9% even though they had a revenue beat. All right, let's come back here. Let me make this a little larger for you. All right. So we want to go to the checklist items now. I want to see if this is a shareholder-friendly management team. For executive compensation, we go to the proxy statement. And in 2017, Francisco de Souza earned a total comp of $12.2 million. Now, some people may say that's pretty excessive. Now, it is a $49 billion market cap company, so it's a big company. But here's why I think he's a very shareholder-friendly company. His base salary of $669,000, that's just 5.5% of the total compensation up here of $12.2 million. Almost $11 million of his compensation came from performance-based stock units. Now, if we go over here to the next page, and I'll show you where we found this information. Let me come back up to my computer. This is a 2018 proxy statement. Let's scroll down a few pages here. Page 35 or so. Let's come back up. Oh, keep going down. Here we go. And I'll take a screenshot of this page. This is the compensation plan, and what you see up here, pay for performance with high percentage of performance-based and long-term equity compensation. And then down here, you see we want to tie a substantial portion of executive officer compensation to achieving both short-term and long-term performance objectives that enhance stockholder value. That's exactly what we want to see if we're investing in this company. And as you can see right here, he's earning $12.2 million, and $11 million of that is from performance-based stock units. So pretty shareholder friendly. All right. Stock performance since the CEO took control. So Francisco D'Souza took over January 2007. And since then, Cognizant has performed 27% annually. So pretty good. Compare that to the peers. ADP is up 27.5%. So slightly better. InfoSystems is up 5.3%. Autodesk is up 21%. Citrix and Fiserv are both killing it at 36% and 42% annually. How's the stock performed compared to the market since 2007? So they're outperforming the S&P 500, which is up 8.45% annually during that time, and the NASDAQ, which is up 9.09% during that time. So clearly they're doing something right. They're doing very well. And then we want to see what the goals are for the company. Francisco D'Souza has a very clear three-point plan, and we find this on the first page of the letters to shareholders. And here is the annual report, year ending 2017. And if you come down just a couple pages, there you go, page number 3. Their three-point plan: investing to scale our 3 digital practice areas, maintain a robust core business, and more importantly, fully implementing our margin improvement and capital program returns. Next thing on the checklist are the executives buying company stock. So we saw 2 purchases this year. The executive vice president bought 18,628 shares, and the director bought 2,500 shares. Now, what we don't want to see is a lot of sales happening around the same time. There were a bunch of sales, but they were mostly exercises of stock options. So if you don't exercise those stock options before they expire, you're going to lose them. And that's okay. Executives are going to sell shares no matter what. They're going to sell shares to diversify their holdings. They're going to sell some of their shares to maybe invest in other businesses, buy a house, buy a yacht. Who knows what they're going to do with it. When you see them selling, that's not a terrible sign. We just don't want to see them all selling around the same time. And we didn't see that here with Cognizant, and we did see 2 purchases. A couple other things. We want to make sure that the management team is doing a very efficient job with the assets they do have. So their return on invested capital is up 12%, and we want to make sure these 3 are growing at 10% annually or better. Return on assets is up 10.23%, and return on equity is just about 14%. So all 3 of those are looking really good. Next, are they doing share buybacks? If so, are they doing that at a discount? And I want to go back here and show you where we're finding this information. Let me go back a slide or 2. All right, so return on invested capital. We're going to go to Morningstar to find this information out. So come up here to Morningstar. We have Cognizant already entered in here. We're going to go to key ratios. So come over to key ratios, scroll down below the financials tab where it says key ratios. And what we see here for the trailing 12 months, return on assets is 10.23, return on equity is 13.99, and return on invested capital is 12.03. And the next item on here, are they doing share buybacks? So we're going to come back to Morningstar, and we're going to go on that same page that we're just on, key ratios. But this one is up a little higher under the financial section. So here are their outstanding shares. Come back a couple of years, 2015, they had 613 million shares outstanding. Then they had 610 million shares, then 595, then 591. So they are buying back shares. They're decreasing each year in the last couple of years. Figure out if they're buying them back at a discount. We need to go back, calculate the average share price when they purchased the stock back, and then what the intrinsic value was at the time of the buyback. All right, so next up, so we took a look at the management team. Management seems to be doing a pretty good job so far. Next, do we understand the business? You have to answer that. Last week, we talked about Disney. It's a very simple business to understand. It's theme parks, it's movies, pretty easy. Now we're getting to some more techie stuff. If you don't understand the business, don't go any further. Go find a company that you do understand. But let's assume that you do understand it and just Even if you don't understand it, I want to still show you how we go through a full analysis of a business, so stick with us. Do they have a moat? And according to Morningstar, they have a narrow moat. So let's come up here. We're going to go back to Morningstar. We're going to get a stock analysis. And we're going to come down a little bit underneath investment thesis where it has economic moat. They have a narrow moat, and it's their switching cost. So switching moat's a pretty good one to have. An example that I'd like to give here is the bank that I use. So the bank that I use, I have my direct deposits set up there. I have, just with the click of a button, I could transfer money from my bank account into my IRA, into my trading account. I have my online bill pay set up there. Even if the bank isn't the greatest bank, or even if they were great when I started, but now they're starting to annoy me a little bit, it's a hassle to switch because I have so many things tied into the bank that it's going to be a pain in the butt to close all those accounts out, cancel the direct deposits, and start that up with another bank. And this company has a switching mode. They have all the technology integrated within a company's business, and it is going to be a hassle to stop doing all that to go to a competitor. In addition to switching mode, some other things here that I think you might want to be aware of. This is a good thing. They have client retention that's in the mid to high 90s. 30% of Cognizant's project team has offices inside of their clients' locations, and that's to build their relationships. And the cost of doing this takes away from their net profit margins, but what it does is it strengthens the customer loyalty. So the profit margins aren't as high because it costs money to do this, but it's worth the investment because they're keeping 95, 96, 97% of their customers, and they're keeping those paying customers year after year. That leads us into the next item here is profit margin improving each year. And it's not. It's decreased each year since 2014. Let's go back to Morningstar. And we're going to go back to key ratios. I'll come down a little bit where it says net profit margins. 2014 net profit margins were 14%. Then 2015, they were 13%, then 11.5%, then 10%, and then trailing 12 months, the profit margin was 9.67%. So they are decreasing it, but if you come back up here to the annual report, we are fully implementing our margin improvement and capital return programs. So they are addressing that issue, and they're doing something about it. And again, if you come back here one slide, one of the reasons why it is so low is because they're putting so much money into building customer relationships and making sure they stay with Cognizant for as long as possible. Their net profit margin is 9.67%. And it's not so great compared to ADP, InfoSystems, and Fiserv. Autodesk is doing something a little wacky there. They're down 27.5%. And Citrix is chugging along at just 3.35%. So next, are they the leader in the industry? I would say they're one of the better businesses in the IT services industry, but not number one. Some other things we want to look at are earnings per share growing at 10% annually. And they sure are. They're growing at 23.5% over the last 10 years. So let's go over to Value Line, their annual rates. So over the last 10 years, earnings per share have grown at 23.5% annually. Are they growing consistently? Earnings per share has grown every single year since 2002, and that's as far back as Value Line goes. So we're going to come up here on the Value Line report. And what we see here is earnings per share. Let's start over here, 2002. Earnings per share were 7 cents, then 11, then 18, 26, 39, then 58, then 72, 89. Going in 2010, it went up to over $1. And even with the market crash that we had during this time, they're still increasing their earnings. And every single year, it has gone up. So that is something we love to see. And it's also one of the reasons why they have earnings predictability of 100. Is cash flow growing at 10% annually? They're growing at 22.5% over the last 10 years. And all of these growth rates that we're looking at can be found right here under the annual rates and Value Line. So cash flow is growing at 22.5%. Sales is growing at 24%. Book value is growing at 24.5%. So book value. Sales and EBITDA growing at 10% annually. That's not growing at 10% annually. That's only growing at 7.3. And EBITDA is not found on Morningstar, or excuse me, it's not found on Value Line. So we have to come over here to Morningstar to find that. Let's go to the financial statements. Now, in this chart here, in the previous chart, the more recent years are over on the left side, but now the more recent information is on the right side of the screen. I don't know why Morningstar does that, but what you see over here is trailing 12 months, 2017, 2016, 2015, and you come back down here, and here's earnings before interest, taxes, depreciation, and amortization. So they're improving year after year without any hiccups. It's just not growing at a rate of 10% annually. Are they debt-free? If not, can debt be paid off within 5 years of cash assets? Most of the companies we're going to look at are not debt-free, and that's fine. We just want to make sure they have enough total cash assets to pay off the long-term debt. But what we see here, and we're going to find this over here on Value Line, their long-term debt is almost $700 million with an M, and their total cash assets are $5.056 billion. So these guys are in superb financial shape. Earnings yield is at 10% or better. It's not. It's at 4.41, and it's not even double the 10-year Treasury yield. I want to know if the F score is 7 or higher. It does pass that metric at 7. Is the PEG ratio under 1.0? The lower the better, and barely. It's at 0.96. If it pays a dividend, which it does, is a dividend adjusted PEG ratio 2.0 or higher? It's not. It's only at 1.07. If you haven't seen a theme yet, let me tell you, all the no's, all the negative things that we've seen so far have to do with valuation. All the positive things that we've seen so far have to do with the actual financial stability of the company. This is a financially sound business. Everything looks phenomenal. But unfortunately, when it comes to the stock being at a discount, it doesn't look like it's there right now. It's not a problem. It's just not a company that we're probably going to be able to buy right now. So ratios, is the current price to earnings ratio lower than historical PE? The current PE is not lower than historical. Right now, the current PE is 22.67. Historical price to earnings is 20. Every so often, you're going to see a discrepancy in earnings per share. We saw it 2 weeks ago with AmerisourceBergen, and we saw it again today with Cognizant Technologies. So earnings per share on Morningstar, on CNBC, on Value Line, they all were slightly off. I didn't know which one was right. I didn't want to assume one was right over the other. So what you have to do is call up the company's investor relations department and find out what the accurate answer is. I called up the investor relations department and nobody answered their phone call all day. Pretty frustrating. So the next thing you can do is go to the 10Qs. Those are the quarterly reports, and look at the most recent 4 quarters. Go a couple pages in, and it has the earnings per share for that quarter. Add the 4 up, and that's going to give you what the trailing 12 months earnings per share are. So is current price to cash flow lower than historical price to cash flow? It is. Current price to book value is lower than historical price to book value. So that's what we want as well. Enterprise value to EBITDA under 10? No, it's at 13. Debt to equity, 0.4 or lower. It's much lower than that. It's 0.07. And it's doing very good for the quick ratio and for the current ratio as well. So those items look positive. Revenues are increasing more than accounts receivable. So revenues are increasing at 25.5%, and receivables are increasing at 22.75%. Let me go here, show you where we find that information at. All right, so we did all this. All right, so the F score. Guru Focus, go to the summary. Got the F score right here. Scale of 0 to 9. 7, 8, 9 is what we're looking for, and it has a 7. PEG ratio, that's the price to earnings ratio divided by the earnings growth rate. So the earnings growth rate Earnings growth rate. Come back down here. 23.5%. So it's growing a little bit higher than what the current price to earnings is. So the next thing I want to show you what to find is the current price to earnings compared to historical price to earnings. So I've taught you this in the course. For the new students who haven't done that yet, here's what we do. So for historical price to earnings, we want to add up, go back till we went to 2010. So 2010, 23.8 plus 22, 25.2 plus 19.5, 19.2, so on and so forth. And then divide these by the number of years that we calculated. That's going to give you the historical price to earnings. So we want to compare that with today's price to earnings. Today's price to earnings is the price of the stock divided by their current earnings per share. And the earnings per share that I used is different than what's on here. I went to the four most recent quarters, and the earnings per share is 3.39. So the stock at the time I did that was 76.86 divided by 3.39. And that's how we came up with that information right here. And we do the same thing for price to cash flow, price to book value. We go to value line. Here's value line. And come up a little bit. Figure out what the price to cash flow is. Go back to 2010. You want to divide 37.4, which is the high of the year, divided by the cash flow of 1.05. Then divide the low price for the year in 2010 of 21 divided by 1.05. And what we do is we do that every year, high divided by the cash flow, the low stock price divided by cash flow per share. Do that from 2010 to 2017. So that's 1, 2, 3, 4, 5, 6, 7. That is 8 calculations we're doing. We're doing a high and a low, so it's actually 8 years, but 16 calculations. So what we do is we add these all up, divide it by 16. That's going to give you the historical price to cash flow. And then to figure out what the current price to cash flow is, you take the price of the stock right now, 76.86, divide it by cash flow per share, 515. And we do the same thing with book value. So that's how you find that information. Enterprise value to EBITDA, this one, we go to Yahoo to find that. And it's right here on the statistics page. Let me come up here a little bit. Cognizant, let's go to statistics. Come down to the bottom. It's 12.92. You could also find that in Guru Focus. You'd find that in the annual reports also. So let me show you where to find the debt to equity, quick ratio, and current ratio. I know we're having to go to a couple different resources, but these are all free resources. We're going to come up here to the 30-year financials. I'm going to scroll down a little bit. Here's what we just looked at, enterprise value to EBITDA. So you come over here to trailing 12 month, and that's at 12.91. So slightly different. I think we had 12.92. And then here is the quick ratio. Current ratio and quick ratio are both 3.64. And then debt to equity. I think I passed that one. I think it's up here. Debt to equity, where the heck are you? There we go. Debt to equity. We want it to be 0.4 or less, and this is 0.07. So looking fantastic. Our revenue is increasing more than accounts receivable. So that's where we left off. So let's come to Morningstar, show you where to find the income or revenue. Right here. This is on the income statement. So revenue is $15,176,000,000 trailing 12 months, then $14.8 billion, 13.4, 12.4, 10.6. This is where we're finding the revenue. You can also find it up here, key ratios, and that's the top line. And now come over here to key ratios, and we're going from left to right. So 15 billion to 14.8 billion, 13.4, 12.4, 10.2. Now we have to find accounts receivable. Come back to the financial section. Go to the balance sheet. And here we're going from right to left. And here are the receivables, 2.8 billion, 2.5 billion, 2.2 billion, 1.9, 1.6, and just divide it by the number of years. So Morningstar value line, that's where we're going to find most of the information we're looking at. And for just a couple of things, we need to go to Guru Focus. So for the Z-score and the M-score, this has to be 2.99 or higher. And CTS is crushing that at 9.83. And the M-score has to be negative 2.22 or less. Passes that also at negative 2.59. So let's come up here to Guru Focus. And that is going to be found on the summary page. Summary. And have it right here. Just a little bit down. So right underneath the F score, you have the Z score and you have the M score. So this looks positive, this looks positive, and this looks positive. So all three of those are looking real good. A couple of miscellaneous items. The major risk to the company. We want to look at that. That's very important. And we find that in the annual report. So let's come up here to the annual report. Scroll down a few pages to the table of contents. Now, I'm not going to bore you with all the different items that are in there, but I'll just show you a couple of things that I was able to find. Here we go. All right, the risk factors is in part 1, section 1A, page 12. Here we go. When I went through this, just about every single one of them is down to generic. We had competition could play a part in us having decreasing revenues, economic conditions, the market crashing, all the generic stuff. A couple things did stand out a little bit. I don't know how much of an issue it is. The outcome of the internal investigation being conducted under the oversight of our audit committee of possible violations of the U.S. Foreign Corrupt Policies Act and similar laws and related litigation could have a material adverse effect on our business, annual and interim results of operations, cash flows, and financial conditions. Now, the executive who was in charge of this little gaffe, he was fired. And they have a new guy that took over, I believe it was in 2016. So that's an issue. Next, a substantial portion of our assets and operations are located in India. That's where 70% of their staff is located. And we're subject to regulatory, economic, political, and other uncertainties in India. So that could be cause for concern. I don't know how much of a concern. And then next, you have the anti-outsourcing legislation. If that's adopted, and negative perceptions associated with offshore outsourcing could impair our ability to service our customers and adversely affect our business results of operations and financial conditions. So you had 3 things on there. I honestly don't think any of those sound very bad, but it's something to keep an eye on. Now we have just a couple more items to look at on the checklist. Do 500,000 shares trade daily? We want to make sure this stock has enough liquidity. We don't want to invest in a stock where it's going to really blow up the bid and the ask price or cost us a lot more than we expect to get out of once we get into it. We want to make sure that there's 500,000 traded each day, and there's 3.5 million shares that are traded each day. So that's much more than we need. The more, the better. So come to the main page here on Morningstar. You get a quote, and then you have the current volume, 772,000, and the average daily volume is 3.5. And next, we want to make sure that the market cap is over 300 million, and this is a $45.2 billion market cap corporation. And lastly, are there any major institutional fund managers buying the stock? There's a lot of ways to find this out. You can go to Hedge Fund Wisdom. You can go to the SEC website and find this out yourself. Guru Focus has this. And what I did is I went to Guru Focus, and I did see that there were quite a bit of buys, but there were also quite a bit of sells too. So there weren't enough sells to worry me, but there weren't a lot of purchases either. You go to Guru Trades, and then come down here, and it's processing. Process faster, please. This happened yesterday when I did it. There we go. So you have a couple reduces. You have one sold out. Then you have an ad. You have another sold out. First time purchase, adding to a position, sold out, and another ad. So I'd say probably about 70% sells to 65% sells, 35% buys. All right, so in conclusion, to the investment checklist, this appears to be a very well-run company. Shareholder-friendly CEO, it's debt-free, It has a moat. Excellent stock performance since D'Souza became the CEO. Most of their growth rates look excellent. Earnings have increased every single year without incident since 2002. And if we take a look at the cons, profit margins need to improve. This is one of the three main goals Francisco has going forward. And after reading this in the annual report, it makes sense why net profit margins are so low, and it makes sense that the actual net profit margin may not seem as bad since it's helping them keep their clients. And then all the other cons that they have has to do with valuations. This doesn't mean it's not a great company. It's actually a very, very good company. It just means that Cognizant Technologies may not be trading at a bargain price. And this is based on the PEG ratio, or the dividend adjusted PEG ratio, the earnings yield, enterprise value to EBITDA, and also the current price of earnings compared to historical price of earnings. All in all, this company is an excellent company. It just might not be at that discount right now. So what should we do? Should we buy it? Probably not. Put it on a watch list? Absolutely. And then maybe we should trade it. So let's take a look at a couple trades we could do. Actually, before we get into the trades, I want to go over some valuations here. So we did a bunch of these. The historical price earnings method gave us a potential target price of 68. And as you'll see in the next two or three slides, that's an outlier compared to all the other prices we got. And after looking at this a while, the reason why I think this might be an outlier, this valuation is used for the stable dividend paying, not necessarily a dividend paying company, but not a high tech company like Cognizant. And with a company like Cognizant Technologies, whose price earnings are all over the place, this is not going to be as valuable of a method as it would be for valuing stock like John Deere, Disney, Nike, those types of big blue chip companies. The dividend yield method and the dividend discount model didn't apply to us because last year was the first year that Cognizant started to pay a dividend. Next thing we want to take a look at was a discounted cash flow method. We need the earnings per share, we need the current price earnings, and an equity growth rate. The equity growth rate that we looked at was a combination of the 10-year, 5-year, and current year earnings per share growth rates. That gave us 17%. And we're due this 10 years in the future. Then we need to bring it back to a present price. And the target price that we came up with was $91.31. With the projected cash flow method, the growth rate that we use here was a little bit different. We didn't use just the earnings per share growth rates over the last couple of years. What we did was we took a look at every single one of these growth rates: revenue growth rate, EBITDA, operating income, earnings per share, free cash flow, and the book value growth. And I did it for 10-year, 5-year, and 12-month time frames. So you have 18 entries right here. And if you take a look at all these numbers, this -8's obviously an outlier, and this 46% is an obvious outlier. So I did not include these two in the calculations, but I did the other 16. So adding all these up, divided by 16, that's where I got this figure right here, 17.10 for the growth rate that I'm using. And we're going to use that growth rate. We're going to multiply that by the free cash flow, and we find this in Morningstar. So come up to Morningstar. Let's go to key ratios. And underneath the financials tab towards the bottom, you're going to see free cash flow, 2204, which means $2,204,000,000. We're dropping off the zeros. So 2204, we're going to multiply these two together, and we're going to add that to 80% of the total shareholder equity. And the total shareholder equity, that's going to be found on the balance sheet all the way at the bottom. So the total stockholder equity is $10,669. We're going to use 80% of that. And lastly, we're going to divide that figure. So we're going to take 80% of 10,669. That equals 8,535. We're going to take that and add that to 1710 times 224. And the figure we come up with, we're going to divide that by the total number of outstanding shares, which is also on Morningstar. We're going to go back to key ratios. Under financials, you have outstanding shares of 591 million, but we're going to drop off the zeros for the calculation. Do all this, divided by 591 outstanding shares, gives us a target price of $79.32. Next is the GAVA method. So you have earnings per share plus dividends. We're going to multiply that by 7 plus the revenue or the EBITDA growth rate, whichever is lower, subtracted by The Moody's 30-year AAA bond yield, which is 2.99%. Find that on CNBC. We subtract this, add 7. That gives us 25.91. And we're to multiply that by 3.39 plus the dividend gives us a target price of 87.83. The Yachtman forward rate of return, we're looking at the free cash flow per share. And we're going to divide that by the stock price. That's going to give us 4%. And then we're going to add that to the 10-year revenue or earnings per share growth rate. And the earnings per share growth rate is lower than the revenue growth rate. So we're going to use 17.2%. And we get a stock price of 93.17. And let's just go on, do the rest of them. 78.35 for the price earnings 5-year estimate to net present value. Historical price to book value is 81, and historical price to cash flow gives us almost $90 per share. So let's look at the numbers that we got. Our results, the first one is obviously an outlier, it's 68.30, so we're not going to include that one. All the others seem to be in the same ballpark. 91.31, 79, 87.83, 93.17, 78.35, 81.18, and then 89.87. So the range here is $78.35 on the low end to a high price of 93.17. That gives us an average price of 85.87 for Cognizant. So we're going to compare that to some of the other resources. Morningstar has a price target of 80. Value Line has the low end at 100. That's clearly an outlier, so we're not going to include that one either. TipRanks, Yahoo Finance, and Emerson Money all have right around $89.50. So when you average all those together, we get an average potential price for Cognizant at 87.08. So our prices come up with roughly 86, and then the other resources come up with 87. So we're all in the same ballpark. This is awesome. So now we have a really confident potential target price that we can go by. Right now, the stock's at 77, and the stock could get up to $85, $86, $87 a share. Not enough of a discount. The company's clearly a very stable company. It's run by a great management team, and it's moving in the right direction. Cognizant's trading at a discount, but not enough of a discount. And that's the case for just about every great company in this inflated market. So we need to be patient if we're going to find great companies to invest our money in. I'm definitely going to put Cognizant on my watch list. I wish I could own it, but I can't own it at this price. It doesn't make sense. So until it happens to fall down to a price where I want to buy it, we're going to trade it. So here's the trend right now. Move my goofy looking face up a little higher so you can see this. So what we see here, this is the resistance. It hit resistance right here around March at $85 a share. And it hit support in March. It hit support again in April. It hit support again. And here's the earnings report. This is when the stock was down 4.9% in that trading day because Cognizant lower the earnings per share going forward because of the increased payments you're going to have to pay due to the tax law changes. So it fell through it. And what you see when a stock goes below the support line, that support line will now become the new resistance line. So here is the ceiling now. And here is the new floor. Here's the new support or the bottom, whatever you want to call it. And it's hit that floor a couple different times. It's bounced off it, and what we see now is it's bounced off it again, and it's starting to go up towards the new ceiling. We have a green arrow for the moving average right here. We have a green arrow right here for the stochastics. We have a green arrow right here for the moving average convergence divergence. I don't want to include this one because that is 2 weeks earlier. So that's not as strong of an indicator because it happened so long ago. But within the last couple of days, we did see moving average stochastics and also the green arrow for the Williams percent R. It's right in the middle of the year-to-date high and low. It's bouncing off a new support. It's got 4 green arrows, but 3 recent green arrows. So it's clearly in an uptrend. Option trades that we could do, we could sell a put. I'm definitely going to do that. We could sell a call. We're only going to sell a call if we own the stock. Otherwise, if we're selling a naked call, that has unlimited risk, and I don't like unlimited risk. So we're not going to do that here because we don't own the stock. We can do a credit spread. We talked about that over the last couple of weeks. We can sell a condor, also known as an iron condor, which is an awesome trade we're going to teach you today. We can do a buy rate combo. And that's also one of my favorite transactions. But this involves owning existing shares or purchasing new shares. And we're not going to do that with Cognizant. And we can do any of the above to profit in any market direction. That's what I love about the option trades. We can profit whether the market's up, whether the market's down, or even if it's sideways. So when are we going to sell put options? We've identified a great company that meets most of their criteria or enough of the criteria that we look for, but it's not cheap enough yet. We want to buy the stock, we just don't want to buy it at the current price. So this strategy allows us to get paid to wait for it to come down to a price where we want to buy it at. We get paid a premium whether the market goes up, down, or sideways. It's also a very good strategy to collect premiums to lower your cost basis. So if you own existing shares, say it's $70, or if you sell a put at 70, and then you keep selling puts, and let's just say I sell another one and I collect 50 cents. Well, now my cost basis went from $70 a share minus the 50 cents I just collected down to $69.50. And smart leverage will also enhance your returns. A rule of thumb here with expiration dates: if implied volatility is higher than historical volatility, we're going to sell longer term options. We're going to sell longer term options to take advantage of that expensive premium. We can always buy it back to close out early if we need to. And this allows us to take advantage of those inflated premiums. If implied volatility is lower than historical volatility, we're going to sell shorter term options. So here's a chart for Cognizant that takes a look at the implied volatility chart and the historical volatility. So here's implied volatility right here at 0.17. Here's historical volatility at 0.14. Since implied is higher, we can select an expiration month that's longer term. So we're going to take a look at the January 2019, 2020 options. I had the January 19th on here, and it didn't pay enough for a premium to make it worth it. So I want to go out a year further, take a look at the 2020s. So why are we doing that? It has a much higher premium, $5.90. And as I said in the last slide, we can close out early if we need to. And we also have an opportunity to sell several short-term deep out-of-the-money puts to lower our cost basis. So if we decide to do this transaction right here, I am obligating myself to buy shares of Cognizant at $70 a share anytime between now and 2020. During that time, once I put this trade on, I'm also going to be selling several short-term, deeper out-of-the-money put options. I'm selling the 70 right now because I want to buy the stock. I just don't want to buy it at 77. I'm going to say, you know what? I think $70 a share is pretty good. $70 minus $5.93. That's what I'm collecting in premiums. So I'm actually going to buy the stock with a total cost basis of $64.07. Once I put that trade on, I'm going to probably sell some 62.50s. I'm going to sell maybe a 60 or a 55 because I don't want to buy more all the way down here. The reason I'm doing it is so I can collect these smaller premiums to chip away at this cost basis of 70, which because of this premium I'm collecting is only $64 now. So I want that 64 cost basis to get closer to $60 if possible by the time this option expires. And here's another reason why we're doing it. Earnings are expected to rise to $5.15 by the end of 2019. That's going to increase the value of Cognizant, giving us a much wider margin of safety. So right now, based on the calculations that we did, and based on the Morningstar, TipRanks, Yahoo Finance estimates, the potential target price right now for Cognizant is around $86, $87 a share. If they're increasing their earnings quarter after quarter, 2018 and 2019, that's going to increase the value of Cognizant, maybe giving us a target price $95, maybe even $100 a share. And that's going to widen the moat if our put price is $70 minus a premium at $64. So we're definitely going to do that. So the goal here is to buy Cognizant at a better discount. We're going to sell the January 2020 puts, selecting the $70 strike. We're collecting $5.93 in premiums. One contract represents $593. If we have risk-based margin 30%, we only have to have 30% of the $70 strike price available. That will give us a potential rate of return of 28.23%. If your portfolio is under $100,000, TD Ameritrade will give you 50% risk-based margin. So you're only going to have $35 available to potentially buy the stock if it does fall far enough. So $35, we'll divide this by $35. That's going to give you the rate of return for a 50% risk-based margin of 17%. So we're going to get paid either 28% or 17% to not buy the stock. We're going to get paid that nice rate of return as long as the stock doesn't fall too far. If it stays where it's at, we made a nice double-digit rate of return. If the stock goes up, we made a nice double-digit rate of return. If the stock goes down, we still did pretty well. As long as the stock does not fall too far. If it does fall too far, which is below 70, that's actually the best case scenario because this is a stock that I want to own. I just don't want to own it at this price. Now, this rate of return right here does not include the future short-term puts that we're going to use to lower our cost basis from $70. And if we include that $5.93 premium, our cost basis right now is $64. And we're going to continue to sell further out of the money puts to lower that cost basis even more. So why do a credit spread? This is a great strategy if you want to collect a premium and profit whether the market goes up, down, or sideways. That's why we're doing these option trades. Collect monthly income or short-term profits, and also lower margin requirements. With that put option at $70 a share, potentially the stock go to zero. So you need to have the margin requirements to cover that worst case scenario. When we're doing a credit spread, let's just say we select the $70 strike price, we're also going to have either the 67.50 or the 65 long put to cover the downside risk. So now our total margin requirement is just going to be the difference between the spread, not the entire amount from 70 down to zero. Trading rules, and this applies to credit spreads. We're not going to trade during quarterly earnings. There's too much volatility. We're going to make sure the probability of expiring out of the money is 85% or higher. We're going to make sure we're at least 12% away from the current stock price, and we want to make sure we're making at least 3% a month. And this is a shorter term trade. We want to make sure that we're doing this for 60 days or less. Now, what I wrote here, if you can read my chicken scratch, we have 94% probability of expiring out of the money. So that passed. We're 12% away from the current stock price. That passes. We are not anywhere close to earning 3% a month on this trade. If we're selecting the 65.70 put option, which is 12% away, the stock's at $77 a share, we're going to collect 12 cents. And if we select the $65 option, $2.50 away, we're walking away with 5-cent net credit and $2.50 in risk. So that's not going to give us anywhere near the rate of return we're looking for. And it's not worth risking this trade for a small monthly return. So we're not going to do a credit spread this month. What else can we do? And one of the best neutral strategies that I like to use is called the condor, also known as an iron condor. This allows us to collect 2 premiums instead of just 1. So I don't want you to have to worry that you're learning some new strategy you have to remember. We've already learned what a condor is. It's simply a combination of the bull put credit spread and the bear call credit spread combined. So with the bull put spread, we're selecting a strike price that's below the current price of the stock. That's what we just looked at right here. This is a credit spread. A bear call spread is where we're selecting a strike price above the current price of the stock. And we're still going to follow the credit spread trading rules for the condor. Why trade a condor? You have a much lower margin requirement. Market can either go up or go down. It can't do both at the same time. So you only have margin requirements on one of the 2 spreads. So the condor is a bull put spread and a bear call spread. And you're only going to have the margin requirements on one of those because the market can either go one of the 2 directions. You're not going to lose on both those transactions at the same time. It's impossible. We're also going to do this if we're neutral. If we think the stock's going to go through the roof, we're going to do a bull put spread. If we think the stock's going to tank, we're going to do a bear call spread. If we're neutral, we think the stock's going to trade within a range, we're going to do the condor. And we're going to collect 2 premiums. And this is nice to collect short-term income profits. This shows you the setup. Here's the current price right here. We're going to select a call at 87.50 and then the long call at 90 for protection. And the same thing down here for the put. 12% out of the money equals 67.50. And we're going to sell a further out of the money put at 65. And the way we profit here is if the stock trades between 67.50 to 87.50. As long as it's in this wide $20 range right here, we're going to make a profit. If the stock goes up here, We profit down here, but this is going to be a loser, so we have to close out early. If the stock comes down here, we don't have to worry about this, but we might have to get out of this trade right here. If you're neutral, you think that the stock's going to trade within a range, we have a 20-point range right here where we could be profitable. So let's look at this setup. We're looking at Cognizant. Stock's at $77 a share. Let's take a look at the bull put spread first. We select a $67.50 short strike. It's 94.6% probability of out of the money, but we're only collecting 12 cents there, and then we have to pay 7 cents for the protection. So we're walking away here with 5 cents. Kind of sucks. So let's go to the call side. Here are the calls. We're going to select the 87.50 short strike at 3 cents, and then 90 for the long strike at 2 cents. We're making 1 penny. This is not a typical setup. Usually with the condors, you're going to walk away here making 4 or 5% a month easily. And what we found here is we're collecting 6 cents on a 2.5 spread. Definitely not worth the risk. So the total return here, if we did this trade, current stock $77. And here's the credits we're selecting for the 2 puts. Here are the credits that we're receiving for the calls, making 6 cents. Total money at risk is $250 minus 6 cents. Total return here is 2.45%. That is not good enough for me. But what I did want to look at, and I'm not sure if I want to do it because I'm breaking a trading rule, but if I go down 2 strikes, instead of trading the 87.50, 90, I'm going to trade the 82.50, 85. And I'm going to collect 23 cents to sell the 82.50, and I'm only going to pay 5 cents to buy the 85 put. So I'm walking away here with 18 cents. So I'm getting 18 cents here and 5 cents over here on a $2.50 spread. Now it's starting to look pretty attractive. So here's this setup. Probabilities, 89.4. That looks good. Here's the total net credit, 23 cents. Total money at risk is $2.50 minus that 23. So we're risking $2.27. That total return is the net credit, 23, divided by the total money at risk, 227. So we're making 10.13% rate of return in just 44 days. Total annualized return, divide 365 days, divided by the number of days we're in the transaction, equals 8.29. And we're going to multiply 829 times the rate of return. So annualized out, this is looking pretty good. We're making an 84% rate of return. Now, again, this requires breaking one of the trading rules, which I don't recommend doing. I don't know if I'm going to do this trade. I got some thinking whether I should do it or not. But the reason I'm putting this out there is just so you can see what a condor is and what the potential money is that you could earn. Now, when we looked at the volatility, implied volatility is higher than historical volatility, but at a reading of 0.17, that's still really, really low. So even though implied volatility is higher than historical, that type of volatility in the grand scheme of things is low, and that's why we're not really collecting a whole lot of premiums. But most of the time when you do a condor, you're going to get a pretty good looking rate of return. That's it for today. If you have any questions, join the live Q&A every Wednesday at 12 o'clock. You can access the members forum if you have any questions. And lastly, always feel free to shoot me an email at tom@wallstreetvalue.com. Have a great day, and I'll talk to you guys tomorrow on the live Q&A. Take care.